Hi, it's Kristin Jamieson with Success Mortgage Partners. Today we're going to talk about why you shouldn't use your credit cards excessively or let your payments fall behind if you're trying to get approved for a mortgage or actually in the mortgage loan process. So all of the major credit cards report to the three major credit bureaus, so TransUnion, Equifax, and Experian. So they are reporting. Credit cards have credit limits set aside. Some people have, say a $300 limit, and I've seen some people that have hundreds of thousands of dollars of limits or no limits on their credit card. The utilization of your credit cards actually affects your credit score. The rule of thumb is to try to keep your revolving credit card balances below 30% of the available credit. So say you have a $1,000 limit, you're wanting to keep that below $300, your balance below $300. One, to increase your credit score. Unfortunately, in the mortgage loan process and credit, you're going up against a computer to generate that score. So sometimes we have to find ways to trick it. And one of the best ways to do that is by keeping your revolving balances below 30% of the actual limit on those credit cards. Now, so if you're over 30%, it is going to reserve your credit score, a little bit. And obviously, as you get closer to maxing out the card, you're going to lose more credit points or points to your credit. And if you go over the limit, you're going to see a reduction in your credit score as well. But as your balances rise on your revolving account, so do your monthly payments. So not only, could it affect your credit score, it could affect your qualifying, because the monthly payment on the credit report from the credit card is what we factor into your debt to income ratio. And we talked in a series prior about, every $50 in a monthly payment equates to $10,000 in a purchase price. So if you've matched your credit cards out and say your minimum payment went from $25 to now $125, you've now just reduced your buying power by about $20,000. And that's a lot of money when you're out there shopping for a house. Yes, 0% interest is amazing, and that's great. And a lot of times that, you're only going to get it for, 1, 2, 5 years, whatever the terms of that are. But again, it's credit utilization. So you found a 0% interest card, and now you've taken your 3 other credit cards and that were maybe below 30% and consolidated them into one credit card that now you're probably maybe say 50% of the limit. So you've reserved your credit score, and your 3 cards that may have had $25 monthly payment. If you put all of those together, if those, that monthly payment has now over $75, that can affect again your qualifying for your new home purchase. So it's a game of checks and balances. And I just highly suggest, if you're in the process or wanting to buy a home, to reach out to a mortgage loan officer to review your credit report and what your goals and dreams and desires are with your new home purchase or even your refinance, and come up with a game plan. Because if it's something like that you want to do and it does benefit you financially, it's something that you can do ahead of time, but never try to do it in the mortgage loan process. It really kind of depends on what we're looking for in the process. So say a part of your loan approval was to pay off the credit card. We can do what's called a credit supplement. So even though it hasn't reported to the credit bureaus yet, we can have Kroll, which is who we pull credit through, Kroll Factual Data. We can have them call the creditor and verify that payment had been made and the resulting balance is 0. If you're trying to get the score increase for, say, maybe a better interest rate, doing something like that after closing isn't going to help you, because we would need that done in the process. Again, we're not going to go back and we're not going to verify what you do after closing. I am going to throw in there that you were qualified based on the time, what the snapshot of your life looked like at the time of application. And going under contract or refinance. And some of the loan programs allow us to go up to, say, 55% of your monthly income for all of your obligations. So if you had some credit cards that weren't being used in there, and we've qualified you at 55%, because that's what you can be qualified under per some of the government loan programs out there. And we're doing that as gross income. We're qualifying you based on gross income, not net income. And so we're not even taking out the health insurance or, the income taxes that you have to pay. And then you go and charge some of your, charge up some of your credit cards that may not have been factored in the process. I wouldn't hate for something like that to ever affect you from making your mortgage payment. Because again, we want you to be successful, and buying a house is one of the best investments you can make if treated correctly. The last point that I want to talk about in this series on credit would be some lenders do what's considered a soft credit pull prior to closing. So say we pre-approved you in August and you didn't go under contract until October. Our credit report is still valid. So we wouldn't have to pull a new credit report at the time of application or getting your contract. But sometimes we have to do a soft credit pull prior to closing. So we're not going to re-pull your credit score. We're going to verify if any new debt has been taken out. So if something had changed from your pre-approval till the time you go under contract, so again, you bought a car or you maxed out some of your credit cards, those are conversations you need to have open up with your loan officer. Because we would hate for the day, a couple of days prior to closing, you no longer qualify because we kept those things a secret. If you or anybody you know has any questions on buying a house or credit in the mortgage qualifying process, please don't hesitate to reach out to myself or my team, 352-242-1535. Thanks.